Hey everyone, Rob B here, of course with Rob D, and you are listening to the Property Podcast. It's episode 252, and we're on a mission to turn you into tax experts. And this week, we're looking at powerful tax strategies you need to know about.
Yes, thank you for joining us on the Property Podcast. And you're not just joining Rob and you're not just joining me, you're also joining Russell Smith from Property Hub Tax. He was such a hit last week. We've got him back again to share yet more of his knowledge. So you'll want to have your notepad at the ready for that one, or Evernote if you're a bit more modern. As well as that, we've got a fantastic resource of the week, and we've got a news story that we're very excited about, at least. But before that, Rob, a few things to mention. Firstly, we kicked off 2018's meetups last week, and they're off to a flying start.
Absolutely, indeed. Well done to everybody who got along. January, starting here right. But don't worry if you missed out. The next ones will be here sooner than you think. Go to thepropertyhub.net/meetups and book your place the first Thursday of every month. So the next one, not too far away, so make sure you get along. What's even sooner than that is our next Discovery webinar. What is a Discovery webinar you hear? Well, other than last week, where we told you about a new business we launched, we really didn't talk about our businesses. And that's for good reason, because we just want to keep it content related. So, if you're interested in what we do outside of the podcast, you can still find out. It's very easy. We've created these webinars where you can come along, join Rob and I live, where we talk you through our businesses and what we do to help property investors outside the Property Hub. If you're keen to find out a bit more, join us for free on Monday, that's the 15th, at 6 p.m, and we'll have a fun 30 minutes running through it all. Book your place now at thepropertyhub.net/discover. That's /discover. Book your place there. And as I said, Rob, we did actually talk about a business last week, but that's okay because it was us launching something and we were very excited. And actually the feedback we got on last week's episode was excellent, so it seems we didn't pee anybody off. But far from pee people off, people actually got very excited about what we were doing.
Yeah, on last week's episode, we launched Property Hub Tax for the first time. We said that there were limited places. We said that they would go quickly, and we were not messing around. This isn't some kind of marketing scarcity kind of thing. We genuinely can't see that many people because this is a really hands-on service. There were only 75 places. We said they'd go fast, and they did within the first couple of days, in fact. At the time that we're recording this, a few days after announcing it, the whole of January and the whole of February are booked up. There's a few places left for March. So if you're listening to this, you haven't got in on Property Hub Tax yet and you want to, then go over to thepropertyhub.net/tax. There may be one or two places lurking for March, but chances are they'll have gone as well. So you can get on the waiting list instead to make sure that you are the first to hear when we open up again in April.
Yeah, make sure you get on that list so you do not miss out. Now, Rob, we've got massive news now. It's probably one of the biggest news stories we've ever had on the show. This is really, really important.
Yeah, you're not wrong. Wherever you are, whatever you're doing, stop it right now and focus on this because this is important. We thought that we got one of our predictions wrong when we did our predictions for 2017. But we didn't.
This is better than having children. This is so cool.
Yeah, at some point, we will shut up about our predictions for last year. Probably around about the time we have to announce our how we did this year. So yeah, in our predictions, we got everything right except London. We're always wrong about London, and we thought we were wrong again because I said that prices in London would be flat, and Rob, you said that property prices in London would dip slightly. It looked, when we were recording from the data that we had, like prices had slightly gone up. But no, story from the Evening Standard, London property prices went into reverse last year for the first time since 2009. Homes in the capital fell in value by an average of 0.5% or £2,151 over the course of 2017, according to Nationwide. Well done to us, and particularly well done to you, Rob, because I just said flat and you called the dip and you were correct.
Well, it was close to being flat as well, so we'll both take this one, Rob. Yeah, massive news. We'll probably retire because we managed to get every prediction right. So we're never going to beat that. So maybe we need to stop predicting now and just dine off this. But don't worry, the smugness will end probably in about 4 months' time.
At this point, I feel compelled to try to tie this back into some kind of general learning point or something. But let's be honest, we just put this news story in so we could be right. So one day we'll shut up about this, but today we will shut up about it because we've got equally important things to talk about. We're going to be talking about powerful tax strategies you need to know about. So last week's episode with Russell Smith from Property Hub Tax was a real hit. He managed to explain the key facts behind property tax in a really straightforward way. A lot of people really getting to grips with these ideas for the first time. So this week, using that as our foundation, we're going to go deeper and we're going to look at some specific tax strategies, things that if you want to pay less tax, you should be aware of. So we're really lucky to have Russell back here with us. Lots to get through, so let's get into it. And Russell, one way that comes up to save a lot of tax is to make use of your spouse. Which sounds bad, but I mean using your transferring property ownership if you've got somebody with a higher income than the other. So how can you go about doing that and how can it be helpful?
I think the first thing to say, Rob, is that getting married is an amazing thing for tax purposes. Okay, so that's the first thing to say, and it really can save you a load of tax to get.
And lots of other reasons we must quickly add as well.
I can't advise you on the other reasons. It's just the tax part of it is great, and in terms of property, it really does come in handy. So if you've got properties, you can basically transfer properties to each other without paying capital gains tax. Can't do it with other people, but you can with your spouse. And the reason why you may want to do that is the principle of equalising your income. Okay, so let's suppose you've got someone who earns £100,000 and they've got a partner who earns £10,000, let's say. Well, that couple are going to be paying a huge amount of tax. If you're going to equalise them down to, say, £55,000 each, they would pay a lot less tax. So the principle is, if you're in a household, if you've got a spouse, you want to try and equalise that income because you will just mathematically pay a lot less tax. Now, when we're talking about property income, we're really looking at equalising the income around the rental income. But obviously, you've got to include the other income as well. So you might have employment income, dividend income, self-employed income, limited company income, whatever. But you've got to try and get everything to be equal. Another bonus of being equal is if you're both below £50,000 and have children, you still get to claim child benefits. So there are a few other kind of add-ons as well. But the principle is, and the reason why you would want to transfer to your spouse is to try and equalise your income.
Russell, can you explain the mechanics of moving a property across from your own name into a limited company? So many people are reluctant to do that, and for obvious reasons. It seems from a tax point of view like a nightmare, but it doesn't have to be, right?
So it can be a nightmare. When you move properties from an individual to a limited company, you effectively crystallise a capital gain. Now, I like the word crystallise, but effectively what it means is you're not just really transferring the property, you are selling the property to a limited company. You own the limited company, so effectively you're selling the property to yourself. And what that means, because you're selling something, you potentially can pay capital gains on it. So by moving properties from an individual to a limited company, you may actually accidentally crystallise a capital gain, which you're going to have to pay tax on. Now, the capital gain rules apply. So essentially, it's the profit that you've made on that property. So it's the sales proceeds, which in this case would be the market value at the time of transfer, because you're not actually selling it. There's no cash consideration. There's no cash paid for it. So it's the market value minus the cost that you paid for it. So let's, for example, say you bought a property for £100,000, you sold it for £200,000, you've made a profit of £100,000. That's what the gain would be. And you would pay tax on that. Now, the tax could be fairly hefty, actually. It's 28% if you're a higher rate taxpayer and 18% if you're a basic rate. And you do get £11,000 free, and if you jointly own it, then it's going to be £22,000. But, it's potentially a lot of money. So why would anybody do this? Well, there are two big advantages of doing this, really. The first thing is capital gains tax in this scenario can be avoided. And it can be avoided by claiming something called incorporation relief. What does incorporation relief actually do? It just gets rid of your capital gains tax completely, meaning that you can transfer one or even more properties across to a limited company capital gains free. So why doesn't everyone do this? Because there's a big catch with it. You can only claim incorporation relief if you are a business. So in this case, a property investment business. There's a big difference between a property investment business and someone who's just owning property. You've got to demonstrate that you are working in it. You've got to demonstrate that, you may have a website, that you actually are running a bona fide business rather than just a sidelining property. So if you can demonstrate to HMRC that you are a business, you can then claim incorporation relief. And actually, at the moment, you could even go to HMRC and get pre-clearance, which basically means you argue the case that you are a business, and HMRC say yes or no. If they say yes, brilliant. You move all your properties across, capital gains tax-free. There is a bit of a sales job to do here. We really must try and prove to HMRC that we are a business, a legitimate business. Maybe we've got big plans, etc., etc. And it is a great area for HMRC. But if you can get HMRC to actually agree with you that you're a property investment business, that is fantastic. But let's suppose you can't get incorporation relief, and let's suppose that you actually do crystallise a capital gain and you do have to pay some tax. Well, it's not very good because you've got a cash tax to pay, pretty much straight away. But the way that accounting works on transfers of properties from individual limited company are very interesting. Essentially, you're transferring something of value to a limited company. The limited company cannot pay the sales proceeds, so it basically creates a director's loan account. What's a director's loan account? Essentially, the company owes you money. You've given it a bunch of properties. The limited company has not paid a penny for it. Therefore, the limited company owes you that money. What you've actually then created is a tax-free route to collect dividends and rental income receipts down the line, possibly 5-10 years down the line, completely tax-free. So you really have to do some decent calculations on this to work out whether this is good for you or not. Because if you do transfer property and it ends up with a capital gains tax bill of 20 grand, but you can potentially save £100,000 down the line, you may consider doing that. Now, the £100,000 down the line sounds pretty big, and it could be this big. It does rely on you actually making money in the limited company and then taking out the dividends tax-free. So I think you probably know that you get £5,000 tax-free. You could end up having £100,000 tax-free and utilise this over 10, 20 years. So essentially, you could try and get capital gains tax relief, number one. If that doesn't happen, you could then try to crystallise the gain and then get a decent director's loan account. Now, I don't know how you feel about the £20,000 tax bill to save £100,000 in the future. It's great because obviously it's 5 times the actual tax bill you're paying. Of course, you've really got to look at your cash implications of that because the £20,000 may be payable straight away, whereas £100,000 you may basically get that relief down the line. But it's well worth looking at those two options.
I think it's worth recapping on that because that's really interesting, and I think there's something in there that people may well not be aware of. So if you transfer a property from you as an individual, you sell it to your company and say that property is worth £100,000. The company hasn't paid you anything, so the company owes you £100,000. So are you saying that basically the next £100,000 worth of profits that you extract from the company would be tax-free?
I am saying that, but the only thing I would say is you're going to get your rental income into the limited company. You will pay your corporation tax at 19% on that. So it's after you've paid the 19%, whatever's left over, you can start taking that out tax-free, which can really add up as a saving because after your £5,000 dividend tax-free, which you get anyway, if you're a higher rate payer, you're going to be paying an additional 32.5% dividend tax. Now, if you've got that director's loan there, that tax-free route of taking out money, you're going to be potentially saving 32.5% of 100 grand, which is 32,500. So, it's potentially a lot of money. But it really does depend on how much that capital gains tax bill is in the first place, whether or not you want to do it or not.
But Russell, of course, we've got stamp duty to consider as well.
Yeah, unfortunately, stamp duty is there. So if you transfer properties from an individual to a limited company, you've got to get over the capital gains tax. There's a couple of ways of doing that there. But you've also got the stamp duty. Now, the stamp duty is obviously paid by the purchaser. In this case, it's the limited company. So you will get tax relief for the stamp duty, but not until the company actually sells the property, which could be 10, 20 years down the line. So how do you get round stamp duty? Well, there's only really one way of doing it, and that's essentially changing the nature of the way you do tax returns to a partnership. Now, you may file individual tax returns for yourself, for your partner. You may do that anyway. And you may say to me, well, I'm a partnership. Of course I am. I run it with my partner. No, but you actually need to be a partnership in HMRC's eyes. And by that, I mean, you've got to register a partnership. You've got to do a partnership tax return. You've really got to trade for at least a couple of years to demonstrate that you are a partnership business. Then you make the transfer. Now, why do you set up a partnership for this? The reason is because if a limited company purchases the property of a partnership, there's no stamp duty to pay. Strange, I know it sounds. It's just one of those things. Transfer it from an individual, definitely stamp duty. Transfer it from a bona fide partnership, yeah, there's no stamp duty to pay.
So some people listening won't have got started at all yet with buying property, which actually puts them in a really good position because they get to get things right from the start. There's also going to be people who've decided, okay, I've got properties in my own name, that's fine, I'm going to leave those as they are, but all properties I buy in the future will be in a company. Both those groups of people are going to be looking to incorporate and actually set up a company. I think it's worth demystifying that a little bit because we get lots of people sort of asking like how to set up a company, what SIC code to use, and all these different things. I think because setting up a company sounds like it should be a big complicated thing. People think of it as being quite intimidating, but it's actually pretty straightforward.
Okay, so limited companies sounds very grand, but actually it isn't as complicated as it sounds. I guess the first thing is setting up a company is relatively straightforward. If you go on any company's house or company formation business on the internet, you can pretty much set them up for £10, £20, not too bad. I would always advise getting an accountant's advice on it, just in case you set it up wrong, but essentially it's relatively straightforward. I have to say, when I speak to people about limited companies, two things. Number one, it isn't as complicated as it sounds. Number two, you do need an accountant to have a limited company, I would say. If you've not got an accountant now because you're running your property for an individual and you're perfectly happy to do a tax return, that's totally great. I think once you get into a limited company, you really do want an accountant's advice on it. Even if you think you're going to do it yourself, number one, it's very, very tricky to do it and learn it. Number two, it will take you absolutely ages. It really isn't worth it. So I'd get a decent accountant for that limited company work. And a decent accountant would do 99% of the work for you. Really, all you should be doing is the signing off of the accounts. If you get a decent accountant who can also explain what's going on, I would say within 3 to 6 months, you'll be absolutely fine running a limited company. So I wouldn't want anybody to be put off from running a limited company, especially because it's such a good vehicle to hold property in at the moment, mainly because you can deduct mortgage interest from your rental income, which you can't as an individual anymore. So limited company, couple of things. You've got to work out what your registered office is, so where you're actually going to put it, what the name of the company is, and to be honest, don't spend ages on the name. It really doesn't matter too much. And the third thing is the share structure. So who's actually going to, receive the money from the limited company. Now, limited companies have directors and shareholders. Directors, really, their only job is to run the company. That's kind of it. So being a director doesn't mean that much, but being a shareholder really does. Because whatever you do the shareholder split as 50-50 between you and your wife or husband, 50-50 you and a friend, whatever it is, that really does matter. Because essentially you are now saying any money that this company makes, we can take this money out of this split. So that is really, really important. So people look at limited companies as a kind of long-term planning. They talk about limited companies in terms of inheritance tax planning and all that stuff. It kind of isn't really to do much with that. It really is a vehicle for holding property and collecting the rental income. So let's just talk about who you'd put as a shareholder. Certainly, if you're married or in a civil partnership, you would certainly want to put your partner there because that will give you the opportunity, as I said before, to equalise your income out. So that will be really, really beneficial to you. Should you put your children on there? I would say no. You kind of never would do this. People think that they could put their children on the limited company and effectively pass money to their children that way. And the answer to that is you just cannot do that. I mean, you could do that, but HMRC just tax the children essentially as if you're you. So any income going to your children is essentially the same income as you. So it really isn't worth doing it because it's not a tax effective way of doing it. Some people put their parents on. And I always say to people, absolutely fine. Put your parents on. That's absolutely great. But you've really got to give them the money. You really can't just put £5,000 to my mum and not actually give her the money. You know, if you like your mum, you want to give her £5,000, great, by all means do it. But whatever you do say you're going to give, you've got to give them to it. Now, you could say to me, well, okay, can I give to my mum and dad? Can they give me the money back? Well, there's ways of doing that. You do have, there's planning that we can put around that. But remember, any transfers of value can attract capital gains tax. So it isn't that simple. It's possible to do if you keep within the annual exemptions of capital gains tax, which are £3,000 a year. But it's not as simple as saying, okay, I'll give £20,000 to my mum, she'll give it back, brilliant. Because you could find yourself attracting capital gains tax there. So be careful with who you put on, because you really do need to give the money. Now, one thing I will say about transferring wealth, parents can be useful in terms of passing wealth to your children, because grandparents passing wealth to the children is not the same as a parents passing wealth to the children. So there's a couple of ways we can look at that. Generally, it's used by paying things like school fees or even university fees. So there are things you can do to set up that. But with share structures, you've really got to ask yourself, am I actually going to give this money to someone? If I am, then great. If you're not, then don't even do it.
So Russell, if that is not the best way to pass on wealth, how do I pass on money to my children or whoever else I want to? Hopefully through property I'm going to build up some wealth, but I want this to be more than just for my lifetime. I want to pass it on. What can I do?
Okay, let's just define how much money we're talking. Okay, so if your property portfolio and your total wealth is below £650,000, and by that I mean as a couple, you really don't have a problem, because you don't pay any inheritance tax on estates that are under £650,000. You essentially get £325,000 for yourself and £325,000 for your partner. So, you know, married or in a civil partnership. So anything below 650, really don't worry about it. There is new rules coming in over the next few years that's actually going to increase that limit to £1 million. So soon we'll have a £1 million limit. So really, you know, if you're under £1 million, probably not an issue. However, if you are above those two numbers, then yes, you've got an issue. And by an issue, what this means is, let's suppose right now you've got a estate worth £1.5 million. Anything over the tax-free amount of inheritance tax, you will pay 40% on it if you die. Now, you may say, yeah, but I'm dead, who cares? Well, that means that whoever you want to receive your wealth is going to pay 40%. That's not great. That's a huge chunk of the hard-earned cash and the hard-earned wealth that you've built all through your life. So if you're anywhere near those numbers, you've really got to start thinking about how you get money to your kids now. So you've asked me, Rob, how do we actually do it? Well, you actually do it by setting up trusts, okay? Now, before I go into trusts, you can actually give wealth to your children straight away. You can kind of do that. And generally speaking, there may not be any tax to pay. The only big caveat is you've got to live for 7 years, okay? You've got to live for 7 years. If you do that, fantastic. The only problem with that is you can't guarantee you're going to live for 7 years. So that's one of the problems. But if you did live for 7 years, you could easily pass wealth on to your children. But I'm going to assume that you don't know that's going to be true. So if you don't know that's going to be true, you're above the inheritance tax limits, you've got a problem. What do? Trusts. Now, what's a trust? You've probably heard a million types of trusts, and there are lots of different types of trusts. But in its simplest form, trust is somewhere you put something, okay? It's like a box. You put it in a box for a rainy day. So you either put a property or stocks and shares or cash. You put it in a box and you safeguard that box with a nice big lock. And that lock says that nobody can touch this money until a certain date down the line. You say that someone can open that box, and that box is probably going to be your children. Now, key point here is you can't touch that box either. So if you set up a trust, set up a box, put a property in, you can't touch it. Only your children or whoever you set up as your beneficiaries can touch this. So there are some serious restrictions on the wealth here. So why would you do this? You do this because it avoids inheritance tax. You do pay some tax, but it's a fairly low rate compared to the big 40% of inheritance tax that you actually pay if you die without any planning. And it's often asked to me, yeah, but what if I set up a will? Wills don't matter. Wills don't mean anything. You've really got to start setting up trust to actually protect your wealth for your children.
So trusts are a great way of getting around inheritance tax by the sounds of it. Is there anything else you can use trusts for?
One of the things you can use trusts for, which is not necessarily inheritance tax planning, is paying for private school fees. Now, if you were to pay for private school fees just out of your own pocket, essentially you're paying for after-tax receipts. So maybe you've got employment, or maybe you've got a business, and you're taking money out of your company, or you're taking money from your employer, and you've been taxed, and then you pay private school fees. Now, you might know private school fees are quite a lot, but actually they're really a lot if you're actually being taxed on it as well. So there is ways of how you can actually save tax here by paying private school fees on your before tax income. Now, the way you do this is set up a family trust. And this is the crucial point, it's the grandparents that get involved here. It's the grandparents putting money in and transferring that money to the children. That's how you get around any sort of tax which I've talked about before. If you were just to do it yourself, you'd be taxed yourself. If you do it grandparents, it's different. That generation does make a big difference. So you essentially set up a family trust and put money in it, and then give that money for the benefit of your children for private school fees. It's a very useful way of paying private school fees and can save you a lot of money.
Russell, we have so many listeners around the world. We're so international here at the Property Podcast. But because of that, we have plenty of people with tax challenges who want to invest in the UK, who do invest in the UK, but their tax situations are clearly a bit more complex. However, I'm sure while there are some disadvantages, there are advantages too. Can you give us a summary of both, please?
Yeah, so if you're living overseas, the tax rules, the normal tax rules may not apply in the same way, okay? Now, you've really got to be looking at how long you've actually lived overseas, etc., to work out what country you're actually resident in. That really does matter. But I'm going to assume that you've been living overseas for quite a while. And essentially, there are a few advantages here, actually, if you've got property in the UK. And because you earn money overseas, you basically get some of the lower rates of tax straight away. So in the UK, you get a personal allowance, which is £11,500 tax-free, and then you get the basic rate of tax. Now, if you were living in the UK, all of your income, be it employed income or dividend income from businesses, would basically add up, and the property income would sit on top, and you'd potentially be paying higher rate tax on your rental income. Not so the case if you're in overseas. If you're overseas and you're earning money overseas, basically the clock starts at zero again, which means you get your personal allowance, you get your basic rate of tax, and what we've potentially seen is people with reasonably decent large portfolios are still paying tax at the basic rate. Well, that's fantastic, number one, because you're paying a lower rate of tax. It's also fantastic because you're deducting your mortgage interest, because as we know, you only lose your mortgage interest at the higher rate. If you're a basic rate payer, then you keep it. So if you're an overseas investor, you get a double whammy of lower tax rates and you get to keep your mortgage interest as well. But you've really got to make sure you get decent advice from an accountant. Make sure you know what resident you're in and make sure that these rules do apply to you. If they do, it's absolutely fantastic. You also really do want to check out your tax rules in the country that you're living in, just to make sure that they don't trip you up. Different countries do have different tax laws. Now, most countries will have a double tax treaty with the UK, which essentially means you don't get taxed twice. But you've really got to double check that. But, in essence, being an overseas investor can really be good for you if you're, investing in UK property.
Amazing stuff, again, from Russell, but amazing stuff from you guys, because you keep leaving us 5-star reviews, and we love you for it. Thank you so much. And, of course, this week's no exception. So a huge round of applause, please, for these wonderful human beings. First up is Rich, and Rich says, always inspiring and entertaining. Thanks very much to Property's answer to Ant and Deck. Thanks for all your team's hard work. Another quick one in from Happy iPad that says, the two Robs chatter away and are full of information, ideas, and discuss the not so talked about areas of property. It really is sitting in with a couple of mates who tell it like it is in a non-patronising way and are so passionate. And finally, I'm going to squeeze one more in, Rob, because this is another quick one. HGVGD says, I've listened to every episode now while renovating our own home twice. I've also now handed in my resignation at work and I'm selling my home to use the capital to set up my own property business. Thank you, Rob and Rob, for all the great content. Wow, some great reviews there, and good luck to HGVGD. Good luck with your business, but please work on your branding. That name I'm not sure will fly. Resource of the week time, and this one, Rob, I really like the look of. People are going to be wanting to make a difference this year, I'm sure, as part of their goals. And this resource that you found looks like you can do just that.
Yeah, this is one that I think fits really well with this episode about tax, because it kind of takes us back to why we're doing all of this in the first place. So why do we want to pay less tax? Well, personally, it's so I can control over what happens to more of my money. And like most people, I'm going to allocate the most of that money to myself. But I also want to use some of that money to give to other people in a way that really helps and really makes a difference. Now, one way of doing that would be just to pay the tax, because in theory, the money that you pay to the government, it pays for the services that you use, and it pays for helping out other people, both in the UK and abroad. However, I believe that most money spent by governments isn't spent particularly well or especially efficiently. And clearly, whether they think it consciously or not, a lot of people think the same thing, because most people want to pay tax, but a lot of people are very generous when it comes to giving to charity. When people die, it's very common to leave a gift to charity, but almost nobody leaves a gift to HMRC. In fact, most people go out of their way to give less to the government when they die. So if giving money through tax is not the most efficient way of making a difference, then what is? That's what this resource of the week is all about. It's called The Life You Can Save, thelifeyoucansave.org, and it's part of a movement called effective altruism. This is something that's associated with the Gates Foundation and with Warren Buffett. The basic idea is you've got some money and you want to spend that money in a way that's going to make the most difference. So you want to help as many people as possible. You want to make as big a change to their lives as possible. So part of that is about making sure that as little as possible gets wasted on admin and wages and all that sort of thing. There's more to it than that, but that's the gist. And what this website has done is identified charities where they believe that by donating, you will be making the biggest difference, basically getting the most bang for your buck. It's really simple to use. You can go on there, you can look at all the different causes. You could read their analysis of how they've come to the conclusion that this charity is particularly effective and makes a really big difference. And then you can easily go through and donate from there. So if you are thinking about charity and how you can make a difference at this time of year, which I know a lot of people are, then this is a really great resource to help you do exactly that.
Awesome resource and well timed as well, because let's face it, if we're doing it just for ourselves and only for ourselves, it's nowhere near as rewarding. So whether it's charity or friends or family that you want to help out, or whatever your cause, wherever your mission, if you haven't got a big why, if you haven't got something that's pushing you on, then when it gets difficult and when it gets hard, then you're more inclined to give up. So having that why, having that purpose, having that passion is going to help you hit the goals and get through the difficult periods, which will come. So great resource this week. Really, really good.
So remember, we've got the Discovery webinar coming up next Monday. That's the 15th at 6 p.m. If you haven't been on a Discovery webinar before, then join us for that. You can sign up at thepropertyhub.net/discover. If you have joined us before, you're very welcome again, but it's just going to be the same thing. For today, though, that's all we've got. Thank you so much to Russell for sharing his knowledge, and thank you to you for listening. We'll see you next week. Bye-bye.
Bye-bye.
Thanks for listening to The Property Podcast. For show notes, all our past episodes, and to leave a review, go to thepropertyhub.net/podcast.